When you think of the term price channel, you're probably thinking something along the lines of two parallel trend lines on a chart where the price of the stock seems to trade, to the top of the trend line and then maybe work its way down to the lower trend line. You can see an example here. But in this video, I'm going to share a strategy using a different type of price channel and how it can be used for selling high probability put credit spreads. And we're going to take a look at 23 years of data from the SPY ETF, and I think you're really going to find these stats pretty cool. So my name is Eric, and welcome to this week's edition of Liquid Options. It's a weekly trading show about options. I hope you'll join me every Wednesday night for a new episode right here on YouTube. And if you haven't done so already, be sure to subscribe to the channel and click that little bell to get a reminder for next week's show. The Price Channel trading strategy is coming right up. So before we dive into the price channel strategy for selling put credit spreads, let's real quick talk about what it means to sell a put credit spread. And I know a lot of you guys already know this, and that's fine, but it kind of ties into the strategy. So I just want to cover that real quick here. So as most of you know, when you sell a put credit spread or a bull put spread, the goal of the trade really is for you to sell something at one price and you want it to lose value over time so that you can either buy it back cheaper or even just let it expire worthless. So in some cases that happens. So for this to happen, for you to sell something and for it to lose value, in this case a put spread, the price of the stock, in this case we're looking at the SPY, the ETF, the price needs to stay above the put spread that you sold. So for example, if I sell a put spread down here, if let's say I sell the 260 put and I buy the 257.5 put for protection, this is my put credit spread. I'm going to receive a credit, and the goal over the next week or two or whatever the time frame is that I sold is for the price of the ETF to stay above these levels. If it does, this would expire worthless. Now, sometimes if the market rallies, it becomes cheaper faster and you can buy it back, and there's all kinds of variations of things. But in general, the goal is for the market or the stock to stay above the put spread that you sold. So since this strategy is, relatively bullish strategy, the next thing we need to kind of understand is when should you do this? And if you guys watched my last video on the SPY, we talked a little bit about bull and bear markets. And essentially what I'm doing in this study is, I really only want to put on bullish strategies when the market is relatively bullish. And the sort of determining factor or defining that market type is I'm putting as the 200-day moving average. So I zoom out. This is what this moving average is. It's the 200-day simple moving average. And so we're going to look at selling the put spreads only if we're trading above the 200-day moving average. And we're going to talk about the price channel in a second. But essentially, we only want to trade bullish strategies in bullish markets. And there's other strategies we can do later. But for this strategy, we're going to look at 20 years of data with the price channel. But the market has to be trading above that. So just want to make sure you understand that when we start looking at some of these numbers. Okay, so the next thing we want to look at is, let's talk about price channel. I know you guys probably read some books and you looked it up and you've seen what price channels are. And, a lot of times price channels are defined as, sort of trend lines between levels. And this is not a good example, but you kind of get the gist of it. This could be considered a really sloppy price channel. But the point is, you have a channel that the stock is trading in. And in this case, this is kind of a bullish price channel, and then it kind of broke out, and it's it's all kind of stuff right now. But we're not going to be looking at trend line based price channels. We're going to be looking at strictly a price channel. So let me clear off these drawings and let me show you what I mean. So what I'm going to do is I'm going to come into my studies here, and I'm just going to come over to Thinkorswim, and this is what they refer to as a price channel. And I'm going to set, you'll see why in a minute, I'm going to set this to 10, and we'll put that on there. And now I have a price channel. This is a different type of price channel that surrounds price. And since I set it to 10 and we're looking at the daily chart, we're basically looking at two lines. The bottom line is the 10-day low. The top line is the 10-day high. So that is the channel. And you can see that as the price moves up, so does the 10-day low, because it looks at whatever the previous 10-day low was, and then as it moves up, the price moves up, the lows move up, and you can kind of see that this kind of keeps happening. You can see that in this kind of surge up, we had a really high moving 10-period low. And then you have the high here as well. So this is the price channel. It's the 10-day high and the 10-day low, and they can expand and contract depending on, the volatility and depending on how fast this thing moves. And what we're going to be focused on is this 10-day low. So let's tie this back into options and put credit spreads real quick. So just conceptually, and I'm going to zoom in here. When we're at the 10-day high, volatility most likely has contracted because we are bullish. And as in this case, the SPY, it sold off a few days in a row and eventually hit a 10-day low. So that's typically when you want to be a seller of options, like in the put credit spread strategy, where volatility has risen because the market is selling off. So by trading put credit spreads at the 10-day low, you're going to get a little bit better price than if you're trading credit spreads at the 10-day high. And there's a million studies on buying the dip and all these other things. You guys can look all that stuff up, but essentially buying or getting long, I should say, at the 10-day low is definitely a higher probability of profit than it is buying at the 10-day high or the breakout. So from an option perspective, though, what we're concerned about is selling put credit spreads at the 10-day low. And then what we want to do is we want time to pass, and we want that, as we mentioned before, to make money in the put credit spread. We want time to pass, and we want to see how long the price stays above those levels. So that's kind of the foundation of the strategy. And we're going to we're going to keep diving into some details here, but that's the foundation here. We're looking at selling put credit spreads at 10-day lows, and we're actually going to look at selling them out of the money, not right at the low. And we'll look at the probabilities that it stays out of the money the last 20 years. So let's zoom in real quick and just kind of do a conceptual sort of trade setup, and then we'll look at the statistics. So you can see this was, from the time of doing this video, it's about a week and a half ago, maybe 2 weeks ago. You can see the market had kind of hit a 10-day high, which, remember, 10 days is 2 weeks because we're talking about trading days, and so it's not 14 calendar days, it's 10 trading days, which is 2 weeks. So we hit a 10-day high or 2-week high, and the market sold off 1, 2, 3, 4 days in a row, had a little bit of a dip. And then if you count backwards here, you can see that the 10-day low line actually dipped as well. And you can see that because if we count backwards to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, the low was here. That is, let me draw this in just so we kind of understand the channel part of it. So if I draw this was the 10-day low was from this candle because it was 10 days back. Well, this candle kind of went through that. So the very next day, the 10-day low is now the low of this candle. So on this particular day, that would be a trading signal to where we would want to sell a put credit spread and out of the money, and we'll talk about how far in a minute. But we essentially want to sell a put credit spread when it's hitting that 10-day low because of two things. First, it's still above the 200-day moving average. So I know we're kind of teetering on there right now. However, from the backtest study, we are looking at trades above, or trigger points, we like to call them. This is a trigger point. It's above the 200-day moving average, and we hit a 10-day low. So we look to sell a put credit spread that's a little bit out of the money. And then we look for time to pass for the put credit spread to lose value, or, if we rally from here, great, this thing's going to go worthless, right? So that's essentially what the setup is we're looking for a pullback into the 10-day low, making a new 10-day low, not a close, a low. And if it's still above the 200-day moving average, we would consider selling a put credit spread. And we're going to use the example of 4% out of the money. If you look at 4% out of the money, and we'll kind of dive into this in a minute, we're going to look at what deltas those are. They tend to be in the low 20 to 25 delta range, and we'll kind of talk about that. So in this example, if we sold a put credit spread that's 4% out of the money, at the time that we made this low, let's say it's the end of the day, we realize we make a new low. At that time, the low was right around 263. So if I bring up a calculator here, it's a giant calculator, but if I do 263 times 0.96, that would be 4% lower. We get a level of 252. And you can see that 252 is way below. Let me zoom out a little bit. 252 is down in this area. Okay, so again, you're selling a pretty safe out of the money put credit spread when you're hitting this 10-day low. All right, so let's take a quick second before we dive into the option chain, and we'll look at the deltas. Let's look at the backtest result. Okay, so here's my spreadsheet, and basically what I've done is I had someone help me because I'm not super adept in Excel, but basically we took over 20 years. This goes back to 1995. And we've configured the spreadsheet. We have the 200-day moving average, and this can be changed. We can do EMA and no moving average. I like to just kind of stick to the 200. And the trigger point is the 10-day low. And this is the lower low scenario. So then 10 days later is how far we're looking in, currently in this spreadsheet. So, and then we're looking at 0.96% of the trigger point, which is what we just looked at in the calculator. So what this information from the past 23 years, this goes all the way up to, first quarter or so of this year, when the SPY, and let me just kind of put this in a, sentence format. For the past 23 years, when the SPY hit a new 10-day low, 10 days later, it was above the 4% below level 94% of the time. So let me go back to the chart because that might make more sense to you here. So again, when the SPY hit a 10-day low and it was still above the 200-day moving average, 94% of the time it was above the 252 level down here, or 4% lower 94% of the time. Now, does that mean 10 days later, if you sold a 30-day credit spread, put credit spread, does that mean you're making money? The answer is no, because you could still sell off and be down in the trade. So 10 days may not be enough, and this is where you kind of have to think about what time frame of an option seller you are. So 10 days, you're not going to get a huge amount of credit 4% away from the money with only 10 days to expiration. So let's go back to the spreadsheet. And when I'm still in the camp of taking partial profits. So when I sell a put credit spread, I like to sell something closer to 40 to 50, maybe even 60 days later. And maybe not for this particular study, but I like that 40 to 50 day range. And so I know, theoretically that if I can stay in the trade and the strikes stay below price for 20 days, I know that I can probably collect half my credit. So in this example, let's say I sold the spread, I collected 50 cents or whatever. I know, this is 4 weeks. Remember, these are trading days. 20 days is 4 weeks later. So if my credit spread can stay out of the money 4 weeks later, I should be in the profit area. And obviously, if it rallies, then that's even better. So you notice as I change it to 20, the percentage that it stays above that is actually 90%, which is still pretty good. It's a little bit less than 10 days. And that kind of gets you into, do you want to sell closer to the money or not? But for this, particular example, I'm doing 20 days later, 90% of the time, let's go back to the chart, 90% of the time, the SPY is still going to be above this level 20 days later for the past, 23 years, as long as that was above the 200-day moving average. So I just want you to kind of, think about that, that you can sell a put credit spread on the sell-off and have a pretty good confidence that if you sell something where you can get a decent credit around this far away, you got a good probability that it stays out of the money a little bit later. So we can change this a little bit. If I want to be even safer, I can do 0.95%, which is 5% away. And look, it actually goes back up, which is kind of interesting. So there's a lot of numbers, and I haven't explored every possible combination here. I kind of ended up on 0.96 because you seem to be able to get a pretty decent credit. So let's look at the option chain and just, we'll go back to this example just as our kind of core example here. And this was on 4/24, 2018. So let me get this set up and think back, and then we'll kind of look through it. Okay, so I'm in the think back function or a tab inside of thinkorswim, and I prefer to trade SPX. So even though we're talking about SPY, this is perfectly applicable, I think, to look at SPX. So we're going to put that in there. And again, we're going to go back to the date for April 24, which was a Tuesday. And then we're going to say, okay, now we want to sell a credit spread. I'm going to look at the June. It's got 50 days. And again, this is the cool thing about weekly options. You can actually choose what you want to sell. But let's just kind of stick with the monthlies for this example. So at the time of this day, the SPX was trading at 26.34. So let's put the calculator back up and we'll clear this. We're going to do 26.34 times 0.96 because that's where we want to sell our put credit spread. That puts us at 25.28. So we're going to be looking for either the 25.25 strike or the 25.30. So let's just go to the monthlies here and we'll do 25.30. And here's where I was talking about the deltas. So some people swear by delta 10 and 15 and 20. So the 25.30, which was just around 4% away, was actually a delta 26. And then 25.25 was delta 25. So, you can sort of see that delta 26 is, you could go a little safer if that's what you wanted to do. But let's just, for this example, I'm going to right click and I'm going to sell a vertical here. And let me bring this up. And you can see for this one strike, this is $5 spread, I get about 95 cents. That's pretty good. You can widen this out a little bit because remember the strike we're concerned with is the one we sell, but we can widen this out to 25.20. We get a little bit better credit. For this example, I'll keep it one strike width, so get 95 cents. So on this day, we sold this credit spread for about 95 cents. And then if we fast forward, this was this day, we fast forward 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. We're 11 days over. And if we go back to the Analyze tab, and we'll just go to today's date. Oh, that's the wrong date, sorry. The trade date and the P&L date. Yeah, that's right. So we'll go to today. And you can see that we're already profited $65. So of the $95 or 95 cents we've sold, we could already take well over 50% of the credit and close the trade, which in my case, that's what I would probably do. Because when you actually look at the chart in this example, we got a nice little rally. We probably took profits a few days. So that's really what this strategy is saying is if you're above the 200-day moving average, when you hit a 10-day low, consider selling an out-of-the-money put credit spread about 4% or so and hold it for a couple weeks and give yourself enough time and credit. And we'll go back to the spreadsheet here. You got a pretty good chance that this thing stays out of the money several days later. In this case, the 10-day low with the 20 days later, 4% away, it was about 90%. So I think that fits in if you're selling options or put credit spreads, 30 to 45 days, holding it 20 days, you should be able to get a pretty decent credit. So real quick, if you're interested in getting a copy of this spreadsheet, it's kind of big, so I'm gonna have to put it up in a downloadable area. Let me know in the comments section and I'll try to make that available. Again, there's 20 something years of data. It's not going to update, but you can really play around with these numbers. So let me know in the comment section if you're interested. And if there's enough people interested, I'll figure out how to put this up for you guys. And it'd be super helpful if you guys could like this video and subscribe to the channel as well. So thanks for watching. Again, my name is Eric. I appreciate the support. And I'll talk to you guys next Wednesday night for the next episode of Liquid Options. And I'll talk to you then. Have a great week.